Good evening, friends. Welcome to this second part of risk management using BASEL 2 and 3. In the first part, I've already covered about 16 slides. There was some technical problem. I could not see the screen sharing. Anyway, this 15 slides I will send you separately, or I will attach it either in the beginning of video or afterwards. Now, in the first part, I have explained some historical perspective of why BASEL, what were the improvements from BASEL 1 to BASEL 2, what are the transformation that has taken place, and BASEL 3, what are the rigorous and strict measures that have been introduced, and various tools and techniques, formulas, to use in different aspects, like for liquidity risk management and operational risk management, market risk management. All these things have been covered in detail. I have also given very descriptive write-up in my slides, not only bullet points, and explain the reason, and and I have also given some tips to my banking friends who are going to appear for examination the day after tomorrow. And as far as MCQs are concerned, I already told them I have sent adequate MCQs for risk management as well as balance sheet management, and I have also given what is known as caselets, scenario analysis, situation analysis with answer, almost 1 minute. Of course, compiled from various reliable sources, and I have edited them and updated them. I have not simply cut, copy, pasted and sent them. I hope all these things should enable you to get a distinction. I expect each one of you will get at least more than 60%, even if not distinction. I always use that adage: if you aim at the sky, you will at least be on the tree. So aim at 80%, you will get 75. Okay, aim at 70, you will get at least 60. Okay, with that my wishes, I will continue. This is slide number 16. 15 slides somehow I missed in my first page. I will attach that to my video. So we will go ahead. Now, what were the problems in I don't say problems, let's say some gaps or loopholes, maybe certain things were overlooked in BASEL 1 and BASEL 3, particularly about quality of capital and liquidity risk, systemic. And I was talking about, when I stopped my earlier video, I was talking about systemic risk, unsystemic risk. How systemic risk, even though it can be managed, it cannot be altogether eliminated. How unsystemic risk can be managed using some hedging tools, etc., including securitization and whatever tools that have been introduced in BASEL 3. Okay, we'll go ahead. In this new BASEL 3, I've already talked about how there is not much clarity as far as the definition of capital, the quality of capital, and what is that capital conservation buffer. Now in the BASEL 3, I include a capital conservation buffer. We also introduced counter-cyclical capital buffer. What are the minimum capital standards? And it is not mere normal capital, risk-weighted assets, capital percentage, how it has to be worked out. The formulas have been given. And in the new definition of capital, in Tier 1, what you can include, in Tier 2, what you can include. All these details have been given in my slides. Kindly go through that slides. Apart from common Tier 1, in Tier 1 itself, what is the additional tier? Again, Tier 2, that is taking into account gone concern capital. Tier 1 is for going concern capital. For each of 3 categories, there is a single set of criteria that instruments are required to meet before inclusion in the relevant category. All those details I have given you charts, I have given you diagrams, I have given you tables. All these things will certainly help you in your examination. So I have already explained capital conservation buffer in the beginning. What are the unique elements, components as far as Basel III is concerned. Capital conservation buffer, I have told you, it is a 2.5%. Of course, it was introduced in phases for the last 3-4 years, and we have already, that period is already over. Now every bank has to keep the 2.5% comprised of common equity tier 1. Then outside this periods of stress, banks should hold buffers of capital above the regulatory minimum. See, they have said the 2.5 is more the better. You can have even 3.5 also. Okay, that's what Basel III expects. Apart from that, counter-cyclical capital buffer I have already explained, but again I have given description here. This aims to ensure banking sector capital requirements take account of the macro financial environment in which bank operate, because so that you will be able to observe those shocks. For example, I was talking about COVID impact for the last 2 years, how that our capital credit expansion greatly affected. So for that, the counter-cyclical capital buffer, how it has to be built in. Here there is one big chart I have given. I think I will make it presentation. Now here we will not go for we will not go for all the, which is already over. We started from 2011, 12, 13, 14, 15. Now as of 31st March 2019, what is the latest scenario? It contains all the data. You need not go back. We just see what is as of today. For example, equity minimum common equity capital ratio tier 1, that is 4.5, and CCB capital conservation buffer 2.5. Minimum common equity plus capital conservation buffer both put together 4.5 plus 2.5, that comes to 7. Then deduction from CET1. 100% you have to deduct. What is the deduction? I have covered at the end. Then minimum tier 1, earlier it was 4.5, and in phases we have made it to 6 as of 31st March 2019. So now that makes 8% risk weighted asset capital ratio is 8%, and I have already mentioned for as far as Indian banks are concerned, it is 9. It is according to RBI regulations. For Indian banks 9, for other banks world over 8. So minimum total capital plus plus conservation, that comes to 10.5 for other banks. For us it comes to 11.5, because 9 plus 2.5, 7, 250 plus 9, it comes to 11.5 for us. And fortunately some of the banks in India, they have already crossed even 15, some of them have even 16. Okay, so I have given this chart. Don't unnecessarily, because you are going for examination, they may not ask when it was introduced, what was, they may not, perhaps they will ask what is there as of today, because that extended period is over. I also mentioned only 2 things have been extended now. That 0.625 of buffer percentage, most of the banks already achieved, but it was the regulatory authority said, okay, by 1st October 2021 you achieve. That was because of COVID. Another one is this, the total implementation of entire Basel III norms and regulation. We have time even up to 2023. I am not talking about capital adequacy ratio or buffer ratio. I am talking about other other norms. I think the outcome we will be able to judge only in 2023, matter of another 2 years. So we will go ahead. I have already explained these things, but here I have given examples. Yes, short-term liquidity coverage ratio and long-term net stable funding ratio. Now in liquidity coverage ratio, what exactly it means, I have given example also. For example, the next 30 days, what will be your cash outflow? Do you have top quality, and remember this word, top quality liquid assets to cover that 30% cash outflow? Now for that, the definitions has been given. What is the top quality liquid assets? Okay. Now what are the expected outflow from where? It may be from savings bank, it may be some corporate current account, it may be some fixed deposit, whatever, And here you have to make two different type of ratios. One is short term, I told you 30 days. The another one is, it may be next 1 year. There you must have net stable funding ratio. You must have stable funding capable of meeting the requirement as far as cash outflow is concerned for the next 1 year. So all these things have been defined here. I have given the examples. Please read that clearly. And I have also given formula. Look at this slide number 23. The LCR is a response from BASEL committee to the recent financial crisis. The LCR proposal requires banks to hold high quality, top quality, I use the word, in order to survive in emergent stress scenario. For example, this is COVID was a stress scenario. So formula I have given here, I can't write and show, it is in this slide. Stock of high quality liquid assets. How much high quality liquid assets you have? Okay, which can be converted into cash immediately so that you will meet the requirement for the next, so that there will not be any, it may affect your reputation also. In fact, we have covered the reputation later on. So I repeat the formula. Stock of high quality liquid, how much you have? Let's say 200. Net cash outflow over 30-day period. What will be the net cash outflow? It should be the ratio should be more than 1, or at least worst come to worst equal to 1. Supposing there is a demand for 100 crores, you must have 100 crores of stock of high quality liquid assets. Liquid assets means, like for example, it may be treasury bill, immediately you will be able to sell. Okay, supposing your money is blocked in some fixed asset, will you be able to convert it? Certainly not. So you must have cash, treasury bills, government security, gilt-edged securities, etc. So formula is also there. Very simple formula. You take what is your stock and what is the expected outflow of cash for the next 30 years. It should be more than 100. Okay. At the most equal, I told you. Everything I have mentioned, whatever I am speaking, it should not be lower than 1, higher the better. High quality liquid means we have given what are those high quality liquid assets listed down also. Okay, because I can't go on reading all those things in another. I don't want to make it 3-part. Otherwise, you will not read my slides at all. Long-term NSFR, again, the objectives I have given so that promote more medium and long-term funding. First one we talked about short-term. Short-term means only 30 days. So long-term, it may be 1 year or so. Same thing again. So what is available amount of stable funding? There it was top liquid, yet stable. Whether you have stable assets, stable for let's say another one year, divided by required amount of stable funding. How much you want for the next 1 year or so. This is known as NSFR. Please remember all these abbreviations because as I have observed in the last couple of years, MCQs are asked on this. Okay, remember this. Particularly the list of what is stable liquid fund, what is top liquid assets. I have given all the list also there. For example, deposits or term deposits with maturities of less than 1 year. That would be expected to stay with the institution for an extended period of stress event. Okay. Preferred stock with maturity of greater than 1 year. Liabilities with effective maturities of 1 year or greater. Okay, that is for NSFR. Okay. The required amount of stable funding, potentially liquid exposure, based on RSF factor. All these things have already done that. Now again they have given some percentages. These components of required funding are not equally weighted. 100% of loans longer than 1 year, 80% of loans to retail clients, 50% of loans to corporate clients, and 20% of government and corporate bonds. They have given actually what is the percentage to multiply to arrive at the required stable funding. Okay. For example, all longer period, 100% should be covered. Remaining for 80% loans to retail clients. For retail, it's okay, 85. For the corporate clients, 50%. 20% if it is government and corporate bonds. Okay. These are the weightages. So I talked about systemic risk later on. Here there is one more table I have given. I will make it PowerPoint presentation. Please read this. It's very important. MCQs have been asked on this. Please read this. Quickly I'm going to read what is that I have covered, because you are not attending my class. No, I am just self-recording actually. So there are 3 columns here. One is requirements, and one second column under BASEL 2, third column under BASEL 3. In case there is any question, what are the difference between BASEL 1 and 2? There will not be any descriptive essay answer, but they themselves will give you 4 answers. You know about that. You have to take. You already passed JIV. So CAIIB, you know how to tick the answers. So there are minimum ratio of total capital 10.5. I told you 8 plus 2.5 buffer. For us it is 11.5. Always remember. In third column I have written under BASEL it is 10.5. Common equity to RWA. Common equity actually under BASEL 2 it was only 2%, very less. So now under BASEL 3 450 to 4.50 to 7%. Okay, it can be even as high as 7% also. Tier 1 earlier it was only 4 in BASEL 2. In BASEL 3 it is 6. And Tier 1 capital to RWA based on risk weighted, earlier it was 2, now it is 5. That earlier there was no capital conservation buffer, now it is 2.5. Please remember. The next one, leverage ratio. Earlier there was no leverage ratio at all, now it is 3%. I was giving example of Lehman Brothers and how they failed. With all this implementation, unfortunately, it is a shocking data. If I mention our stressed assets, what is known as non-NPL, and globally it is also referred as toxic assets. Can you believe 8.5 trillion? For trillion 12 zeros. Are you aware of that? 8.5 trillion. And almost 12% of NPA. Of course, it is gross NPA. They have made some provision. Then we may call it net NPA less than 5, whatever. That is different. But anyway, the amount is startling. During our banking period, we never heard it was in trillion. It was not even in billion. With no advanced technology, everything we used to do manually. Anyway, we are not here to criticize the things, but with all that, we only hope that our NPL, you would have heard about one, if I talk in normal course, haircut means cutting the hair, but bankers are getting more and more of haircut. That the bad bank is going to come and we are going to sell all our NPLs. God forbid we will not become bald. Haircut, sometimes it is as high as 45%, 50%. We are selling it for such a low. So that is. This haircut is officially used, the word. It's been used in BASEL, been used in RBI guidelines also. Otherwise, the outsider who is not a banker, RBI was talking about haircut for banker. Something really funny. Okay. Now, look at this. Very, very clear 3 charts. Now, for example, for market risk, credit risk, operation risk, what is the minimum ratio required, what is the definition, what was the definition under BASEL 2, what was the definition of BASEL 3. Very nice chart I have given. Okay, now for example it talks about VAR. I told V, capital V, small a, and capital R, value at risk. Then stress VAR, and increased margin period, then sensitivity analysis, scenario analysis, stimulation analysis, back testing. So all these things have been defined here. So now I don't want to read that. Unnecessarily it will be mere reading from the screen. You can read that, but I have given an idea. What was there in BASEL 2? I told there was some lack of clarity in certain definition. So the BASEL 3 has taken care of that to overcome whatever gaps were there. Additional deduction to capital, deferred tax allocations. Okay. Then counterparty risk. Here in BASEL 2, of course, it was there, a counterparty risk, and here it is under stressed asset, how the counterparty risk has to be managed. All these definitions are given in one small chart. Please go through that. Now, I have given one more, very very beautifully prepared. It's not I am, I put in a lot of efforts. Here you will see it's very nice actually. Um, I think I don't know if I can. No, let me not turn this off. Um, Basel 3 introduces more rigorous, and it strengthens the linkages that are between three very crucial aspects. What are they? Number one, risk, capital, liquidity. How the risk, capital, and liquidity are interlinked. I have given one very relevant image I have given here. That makes a lot of sense if you read. Compared to Basel 2. In Basel 2, there was no such linkages between how to manage risk, how to manage liquidity, and how to attract capital, how to raise more capital, how to generate more return, ROCE, ROA, ROE. So Basel 3 talks about all these things. And calculation of ROCE, how to calculate ROCE. There is a formula. But here I am not covered because we are not talking about risk management for operation risk, market risk, and liquidity risk. Here my focus is only Basel, its norms. Why the difference between Basel 1, Basel 2? That's what Mohan sir, the academic director of Institute of Banking Studies, asked me. So then if I go on talking on then risk management, it will take hours together. Okay. So that is why I have not brought those issues here. It's a purely Basel and exam oriented one. One more chart, it's beautifully prepared. Capital, liquidity, system risk. For example, capital strengthens the quality, solves all the risk, controls leverages, introduce buffers. In liquidity, setting short-term ratio, setting long-term ratio. In system risk, encouraging the use of clearinghouses for over-the-counter derivatives. They have brought in, derivatives you would have heard. Warren Buffett says they are the distracting tools. In fact, derivatives, bankers, does a lot of derivatives trading, particularly foreign currencies, forward, futures, swaps, swapations, and whatnot. So Warren Buffett says it is like two-edged sword hanging on your head. If you don't know how to manage it, will kill you. I mean, when I say it will kill you financially, it will make you bankrupt. So it has been brought in here, and for SFI I have already talked. Additional capital charge, where the risk is more. I have prepared a very impressive. I have taken a lot of time to prepare all those things. Please make good use of it. Now from here, let me go escape this chart. Slide number 34. I went to do another 15 minutes only, 20 minutes or another 15 minutes only. I have covered RBI guidelines on Basel 3. See, whatever guidelines Basel has given, that is for the global banks as a whole general. But after making a thorough study, the RBI has come out its guidelines. See, I'm not telling RBI has deviated. In fact, it become given the guidelines given by RBI is more stringent, more rigorous. So I have covered another 20 slides talks about only, because now you are going to appear for examination day after tomorrow. They will be covering all RBI guidelines only. As I told you, that runs to hundreds of pages, and I have put it in just 30 slides. Okay, instead of you searching in the book. Even this book, I don't know. I can show you here. You see, it runs to 600 pages. Risk management. And even if you take this, BF Bank Financial Management, it's also about 600 pages. So now if you open the book, you will get thoroughly bored. So I have made it simpler, easier for you. Okay, tier 1, tier 2. Now there are some conditions which have not been, it has been made very clear in Basel, but for us, India, taking into account the Indian condition, some of all these things, my dear banking friends, you have to remember, because the MCQs were based on this. For example, say, tier 2 capital cannot be more than 100% of tier 1 capital. Within tier 1 capital, innovative instruments are limited to 15% of tier 1 capital. Perpetual non-cumulative preference shares, NCPS, along with innovative tier 1 instruments should not exceed 40% of total tier 1 at any point of time. Within tier 2 capital, subordinated debt is limited to a maximum of 50% of tier 1. Now I have told you, you are thoroughly confused. I know even if you ask me to repeat, Professor Rao, please repeat, I will not be able to. Now you have to remember. That is 100%, 15%, 40%, and 20%, 50%. So please read this, remember, and MCQs will come on this. Sure. There were many times it was hard. So there is no point in my reading and repeating. Only I may remember, you may not be able to remember. So please go through this slide. I have all these things, 100% reliable source, because I have taken from RBI guidelines book, which runs to some circular, runs to about 300 pages. So you need not search there, So I have searched all the relevant data I have put here, okay. Under BASEL 3, tier 1 capital will predominantly consist of common equity, the qualifying criteria for instruments to be included in additional tier 1 capital outside the common equity element as well as tier 2 capital is strengthened, and the important modifications include the following. I have given 1, 2, 3, 4. For example, deduction from capital in respect of shortfall in provision to expected losses, ED, and IRB, internal rating based. Earlier I told we used to rely heavily on ratings given by external. I'm not undermining their competence, capability, sometimes in collusion. We can't say, because there were many instances when one credit rating agency, international credit rating agency, I don't know name, they gave AAA plus, and within one week that fellow filed bankruptcy appeal in the court. How could it happen? What type of I'm sorry, I'm not questioning anybody, I don't have any right to question, but it may happen. That is why now we have got internal rating system also, IRB approach, internal rating based system, and how the ratings have to be given. It has been very clearly stated in the book also, okay. Then if it is a pension fund, how it has to be treated, then certain regulatory adjustment which are currently required to be deducted 50%, they have been retained. Then there is one concept called credit value adjustment, how you can make some adjustment. I have written all the details here, defined as having total assets, particularly for such firms whose assets are more than or equivalent to $100 billion. 100 billion into, let's say, 75. So 100 into 75. The total assets. Only for them it is applicable. Even those exceptional cases I have mentioned, who knows, they may ask MCQ on that. So I have given how it has to be calculated, what is known as asset value correlation. Next, all these BASEL guidelines, though it was given by BASEL maybe 11 or 12, 2011, for us, for India, it is effective from 1/1/2013. You may say, what is so great about this period? In one of the MCQ that asked, BASEL 3 came into effective implementation in India from 2011, 12, 13, they had given. I'm not joking. So sometimes even such minor issues also you have to remember. So I have given the date. It came into effective from 1st January 2013. So 8% for all banks. For us it is 9 and 2.5. Then total common equity 7%, including all those things 10.5. Repeatedly I have explained so that you will not miss anything. I have already mentioned under BASEL, and the same thing under RBI guidelines also, but here I have given clear explanations also. Whatever RBI has mentioned, I have given that. Then leverage ratio, that is 3%. Components of capital, what I have already covered in the beginning also. Here also I mentioned, say for example, tier 1 capital should be at least 6% of RWA. This is RBI guidelines, you have to remember, because the MCQs will come on this. Tier 1 capital should be at least 6% of RWA. Tier 1 capital, innovative Tier 1 should be limited only 15%. You will come some exotic, innovative Tier 1 capital, and you can't make it 50% of the equity capital. It should be limited only to 40. Similarly, cumulative CPN, I've already covered. CPN should not be more than 40. In two, three places I have covered, so that you will not miss anything. And next comes how CRAR has to be calculated, and given the formula. And for formula also, for example, they say EPT. What is EPT? Eligible profit up to the quarter T. T means period. Then what is NPT? Net profit. What is D? Average annual dividend. So now, I don't know, in the other video the talk, so supposing you have net profit, surplus profit, you want to distribute a dividend, no, you can't do that. So they have put some conditions. How much dividend you can pay, outflow, how much you can retain, dividend retention ratio, and it is based on how much capital you have. Supposing you have more than 8%, okay, you can give whatever you want to distribute. Otherwise, you have to retain 80%. In some cases, you have to better portion 60. In some cases, 40. So what is that? In some cases, I have given the chart. I have mentioned the percentage as also for your ready reference. You need not go and search anywhere. How this 11.5 has been arrived? In the next chart I have given. Now capital adequacy due to COVID-19 impact, the implementation of the last tranche of 0.625% of the CCB has been deferred to 1st October, but most of the banks have already kept 2.5. For Indian banks, TRWA is 11.1111 into capital market risk plus 11.11 into operation risk. So now you have to provide for risk in market for market, and you have to provide capital for operation risk. How much you have to provide? The percentage has been given, and there is a formula. Please remember this formula. Quite possible they may ask. In general case, it is 12.5 plus capital for market. But for Indian banks, some decimal is given, because we have already, instead of 8, we have been asked to maintain 9. So there is some change here. If I talk here, you may not get what exactly I am talking about. It is please remember this slide number 48. Everything I have mentioned, how to calculate CRA. Okay, capital adequacy ratio. Another 5 minutes, I will be closing. What are the elements of additional tier? I have already talked about the PNCPS, that is perpetual non-cumulative preference shares. There was a question on this MCQ was there, and if it is a debt capital instruments, what is the percentage? I already mentioned here. Then elements of two-tier capital. What are all the things you can add in tier 2? Like for example, general provisions for loss reserves. You already made a reserve. You can show it under tier 2, not under tier 1. Okay. Tier 2, what are the other things you can add? I have already given general provisions for standard asset, floating provisions for country exposures, investment reserve account, which is excess on account of sale of NPA. There are 7 to 8 items are here. I have mentioned here what you can add as tier 2, so that tier 1 and tier 2 put together, it will make 9%. Okay. And of course, you have to remember that is risk weighted according to risk also. What is the risk weightage to be given for each type of asset also, I have mentioned in the slide. Then debt capital, we have talked about PCS. Revaluation reserves, you have to give 55% discount. Let's say, for example, we Bank of Baroda, we have a very big 7-floor building in Parliamentary Street in New Delhi, or in Mumbai, in the frame area. We would have purchased it, let us say 10 crores. Today it may be worth 100 crores. I can't show. It's the same, my asset is, I've got 100 crores. You have to give discount of 55%. You can show only 45. You can't question this. This is the regulation given by the Reserve Bank of India. I mentioned all those things. Supposing head office borrowings, foreign currency received as part of two-tier debt capital, what is the discount to be given, how much you can take into your balance sheet, and supposing it is goodwill, how much goodwill you can show. Of course you can't show goodwill. Then deferred tax adjustment, there some tax you are yet to be paid, and you have made provision. Can I take that as my asset? All this very detailed guidelines have been given by Reserve Bank of India, and how to work out expected default, loss, LGD, PD, probability of default, using that value at risk. Those things I have not covered here because I have already covered in my cases which I have already given you. You have to remember I have given you 100 cases, 100 cases updated and edited by me, of course taken by various. I am thankful to all those bankers, including I think is one Mr. Tiwari from Canara Bank, and incidentally our Satish Sar is from Canara Bank. Our founder, director of Institute of Banking Studies is from Canara Bank. I have collected from various experts, and of course I have ensured that it is from a reliable source. Then securitization transactions, that is the securitization, one of the effective tool to to clean your balance sheet, sell off all NPS and go for a securitization. Finally, the capital conservation. I'm not talking about buffer, capital conservation. Say if your equity tier is up to 6%, 100% you have to keep whatever net profit, you cannot distribute. If it is 6.7, 80% you have to keep, only 20% you can give by way of dividend. If it is 7.375, everything you have to remember. I'm sorry, I can't help it. And 3 digits they have given, the decimals, 7.375. Then you have to retain 60%, you can pay only 40%. If it is 8, okay, retain only 40, give it. If it is more than 8%, that is equity, common equity tier 1, it is not total capital, don't get it confused. Common equity tier, if you have got 8%, most of us we don't have really. Okay, 4, 5, 6, 8 is extremely difficult. I don't know whether HDFC Bank or DCB Bank they may have. Then all right, whatever profit you have, you please you can give by way of dividends. Well, friends, and in the last again one more all calculations I have given. RWAs and tier 2, tier 1 components, PNC, PS, and here that total comes to 14.78%. That is minimum total capital ratio. Comes to 14.7. This is one calculation is there. You please go through that. They may not give any problems, but then last time they had given problems, and a scenario. Then based on that, 3-4 MCQs they had asked. Well, friends, my concluding remarks I will read. Another 2 minutes left. I have made 80 minutes. I am sorry, Monan sir, he asked me to make it 20-20. I have exceeded the limit by 100% because I have given very detailed, descriptive reading, so that any person with the basic knowledge, even 12th standard student, will be able to understand this BASEL. That way it would help for their examinations, for their interview. That's the reason I have made it very descriptive. So here are my concluding remarks. It is estimated that Indian banks require 65 billion US, equivalent to dollars, 65 to 75 to meet the Basel III norms. The gross NPA level, unfortunately, it may reach 12, that's what they say, and the NPL, very startling figure, 8.34 trillions. Our total economy is not in 8.34. Unfortunately, we have so much of toxic assets. That's why all this, strict and rigorous norms. Some of the measures suggested, for example, I have written here, please remember all these things, SRP, supervisory review process, ICAAP, capital, internal capital adequacy assessment process, and SPOR, standard practice for operational risk, then stress test. They are all will be effective in reducing the risk. RWA of PSBs, they have improved, and most of the PSBs now they have a 14% order risk-weighted asset. Risk-weighted, they have crossed even 14%. Some of the banks. Okay, friends, I'm so happy to talk to you. I hope my video will help you, not only my friends, of banking friends whom I have been teaching, and my MBA students, and in fact I have mentored and helped some of my students to pass that FRM, Financial Risk Management, conducted by GARP, Global Association of Risk Professionals. Similarly, there is another institute called Risk Management Institute, RIM. This type of topics will help my friends. All the best. Tomorrow, Ganapati Puja. Perform Ganapati Puja. Believe in God, and I'm sure each one of you will get distinction. Good night. Thank you so much.